Panelists, if you'd like to come to the stage, we will kick off the discussion. Big round of applause for our panelists. Welcome them to the stage. Okay, just grab a microphone. Okay, so we'll sort of divide this discussion up into two parts, really. I'd like to talk a little bit about, first of all, maybe about the gold price, and then we'll talk about gold mining equities, and investing in both sides of that, and the sort of risks and opportunities in those two spaces. So if we can just start with the gold price. It's been fairly steady over the last couple of years. People are thinking, when is it going to maybe break out to the upside? Jürgen, do you want to kick us off on your thoughts on where the gold price is today? Is it in the right place, and where it's going to go in the future?
I think there are a lot of people who are frustrated with precious metals, particularly the prices of it, looking that many other commodities are actually heading north and breaking out on the upside. And a lot of people will wonder, when is this price going to move? And I think the answer is really very difficult to answer, I think for multiple reasons. We have a physical market which is very, very robust. I think the East is buying up more than basically the annual production, and it's disappearing out of Western coffers. So as these Western coffers are emptying, we're actually seeing one phenomenon developing, that the COMEX is not able to deliver any gold at all. And if they have contracts, they're flipping them through London in the exchange of physical contracts, which means basically that the brokers are paying people who are exchanging a physical delivery for paper settlement, so cash settlement. They pay them a premium. This amount this year so far of the settlements been the equivalent of the annual production already. So that tells you actually that the gold price is in backwardation. It might not occur for everybody, but what it basically means, you have different price settings for gold, depending on where you are in the world and how you're getting to your supply. So that tells you basically that the gold price should be reasonably well supported. From a mining point of view, 1250 I think is pretty critical for a big number of the gold industry. I think at 1250, 80% of the gold industry will hardly make any money. So because of that, you will not see capex, you see falling production, you see high grading, you see all the elements you have actually in an environment where prices will have to start rising if you want to get the supply going, particularly environment where your cost pressures are rising. They are rising because of higher commodity prices, steel, labor, and energy. So you will medium term have to see how higher gold prices, otherwise you're going to start seeing defaults in the physical supply chain.
And how do you think these sort of macro factors out there in the world, the sort of geopolitical factors, are impacting gold at the moment? There's a lot of instability out there. Iran, North Korea. There was a threat of a trade war. It's now subsided somewhat. What's your take on the fear side driving the gold price up? Is that still a factor?
I think the fear trade has been driving energy up to a large extent, and I think it's been driving as well physical demand up, particularly in all the countries which had risks of being embargoed by the United States. I think people are looking at what they're going to do with their offshore payment systems, and that's where you see the demand actually coming up quite reasonably. We had a very strong dollar. And despite the strong dollar, you actually have a flat gold price. So it's actually not too bad. And I think once you start seeing the dollar topping out or inflation picking up a bit stronger, I think gold will react and catch up.
Chris, what's your take on this? And demand for physical?
We've definitely seen a rise in terms of the bullion side. For us, we deal with the storage for mainly high net worth, and as you know, gold is a pretty good hedge against things like geopolitical risk and so on. So yeah, we've seen some marginal increase in terms of people wanting to buy and store with us physical at the Freeport. Yeah.
To what extent do you think the rise in demand has been driven by people's fear of something happening, or are they seeing an opportunity as an investment? with a rising gold price?
I think for most of our clients who are on high net worth, the price doesn't really drive it that much. We see very little, people selling even at above 1,300. I think for most of these customers that store with us, they rather purchase, buy gold when it's less volatile, and the storage tends to continue with us for a long period of time, rather than being traded around among different clients.
Typically, for businesses such as yours, how long do people hold their gold before they sell it?
We've had people who have stored with us since day one, which is about 8 years ago now, and they haven't sold any. So, but one of the key initiative that we've done is that we've partnered with a couple of banks in Singapore to provide leverage, LTV up to 70-80%, so that they can actually use that money to, if they require some liquidity for that. So yeah, we although we have a peer-to-peer exchange, there's actually very low volume of people actually selling. Yeah.
They buy and hold.
Yeah, they buy and hold.
Thomas.
I think the fear trade is a bit overrated as a factor for gold. Of course, on a short-term basis, you can see gold spike based on what Donald Trump says on a daily basis. But these movements are usually very short-lived. I think at the end of the day, it's still old-fashioned supply and demand that's ultimately going to drive gold. The problem with it is that the gold price is so manipulated that you don't see the underlying supply-demand structure reflected in the gold price, but ultimately it will. And I agree with Jörg. Ultimately, gold price will have to go much higher. It's almost a mathematical certainty. But I've long given up trying to predict an event and a timing. So when it happens, you never know. But it also looks like now things are converging to a point where we might have a perfect storm for the gold market, where supply is plateauing, and with supply, there's a lot of confusion about supply in the gold market. People are talking about peak gold. I think that's complete nonsense. There is a lot of gold. There's always a question of gold price, how much gold is being produced, and of course, gold is the one. I wouldn't call it a commodity, but the one element with a huge above ground stock. So there's a lot of gold available at the right price. But what's interesting is that annual gold production from mines is plateauing and actually contracting over the next few years. So that's a very positive factor for gold. And at the same time, demand is likely to pick up based on not individual geopolitical events, but the entire geopolitical climate, which is very hostile in general. That should drive up investment demand for gold. At the same time, of course, currencies and inflation is very important for the gold price. And although the dollar is relatively strong right now and might actually go on a bit of a run medium term, but ultimately, I guess the dollar, along with all the paper currencies, will come down again. That in itself will be positive for gold. And then ultimately, I think we will see the inflation that has been so disappointing for the gold investors since 10 years ago in the financial crisis when central banks started printing money. Everyone expected inflation, and it's never showed up, at least not in the official numbers. But I think now that everyone is throwing in a towel and giving up on inflation, it might actually come up and add to the mix, and that might trigger gold to eventually break above 1,400, and then it might quickly run towards 1,500.
Why do you think inflation hasn't happened so far?
It's actually very simple. Fundamentally, you would think when central banks print these amounts of money, it would create monetary inflation, and it did. But the problem is that all this money that the Fed and the other central banks printed, until today, is largely captured inside the banking system, because the main mission of printing this money was not to to save the world economy or any altruistic reason. It was only designed to bail out the banking system. And that's a mission accomplished. But this money is still trapped inside the banking system. So if this ever gets out into the real economy, it finally will create inflation.
Jürgen, what's your take on some of these things? I mean, Thomas covered a few things there. Manipulation of the gold price, is that something you subscribe to, or?
I think that the sheer fact that we have now an exchange for physical through the COMEX to the LME tells you already that we have a manipulation structure because the price is not available for everybody. And I think the sheer fact that we have a few banks which have been actually committed to manipulation already tells you we have that too. So we have a certain manipulation, but how big that is and how much is going to release on the price is a different issue. I think the one thing which I think for people looking forward, because of all these geopolitical tensions we have actually started to see that the West is building up its own little structure in protecting themselves, and the East is doing the same. And if you look at the East, what's really interesting, for the last 2.5 months, we've seen on the oil side that we've had the Shanghai exchange building up the oil futures. And this oil future represents today already 50% of the future in London. That's incredible after 2 months. The first settlement will be in September. A lot of this trade which is being done is probably Iranian oil, Russian oil, many people which are fearing actually sanctions. People should ask themselves, what's going to happen when this future settles? Will it stay in Shanghai? Will it get converted in favor of the gold futures, which is basically directly linked to that? Is it going to start removing even more physical out of the Western supply? And I think September is going to be quite an interesting time to watch to see if the gold price gets liberated because of that.
Sorry, just maybe a little comment on that is that in terms of facilitating the exchange of physical, I mean, that's one of the key points of why we have a peer-to-peer exchange, because this is where within our ecosystem, the buyer and seller is identified, and the physical gold is actually stored with us within the ecosystem. So we don't have that sort of problem within the manipulation. But I think I agree with you that, you know, in some of the paper trades, you have that issues there.
Yeah, maybe you know that Donald Trump reneged on the Iran nuclear deal. Maybe Singapore will emerge as a major gold trading hub, like Dubai did the last time around. But Jörg mentioned an interesting point on the oil futures. I mean, many people have tried before to trade oil not in dollars, and we all know that didn't quite work out for Saddam Hussein and Gaddafi. But now Russia and China are going in this direction, and those countries are a bit too big to swallow for the US to just invade them and extinct them. So this could really be a game changer for the dollar if China and then Russia successfully circumvent the dollar as an oil trading currency.
Mm. And the impact on the gold price? Send it?
Yeah, ceteris paribus, a weak dollar is always good for gold. I mean, there's other factors, but it should be also a major influence in the gold market is simply sentiment. And it sends a signal, not only the direct correlation between the dollar and the gold price, but also it says a lot about the geopolitical environment, and all of these things will only increase tension and hostility. Remember, in the early 80s, when Ronald Reagan became, in later 80s, when Ronald Reagan became president, people talked about the peace dividend in the stock market. So probably now we increasingly have the opposite of it, and that should be positive for gold.
Just to go back a step and talk about some of the sort of traditional big buyers of gold, such as India, how have those sort of traditional markets How are they faring at the moment? What's the demand side looking like in India, for example?
You're asking?
Yeah.
I mean, if you basically look at China and India together, they are basically picking up the global supply of gold. So there's not much left around for anybody else who needs something. So it comes out of warehouses. And it, you know, year by year, we're moving maybe 10% up or down, so it's not really that important, it's 10%. So from the demand supply, basically it's been taken up.
But as an increasing number of people in those countries, you know, get access to bank accounts and things like that, particularly in India, are you going to see people storing physical in their houses, for example, you know, or in jewelry? Is that going to diminish at all?
That's an interesting point. India is one country which still hasn't fallen for the paper gold scam. The Western banks have tried to introduce them, but Indians may not, the average Indian may not understand what's going on in the financial markets, but they have common sense, and they would never put their gold into a bank and say goodbye to it. They basically have a physical storage at home, and that's why India is such a huge market for physical gold. Maybe something like the physical exchange would be very successful in India.
I think I agree with Tom's take on that. I mean, the Indians have always been big buyers of gold and in jewelry form, and there have been various what we call gold accumulation programs that were introduced through, I think, Reliance in the past, and also similarly in China, people tend to like to hold on to physical, and that's where the banks have actually introduced an accumulation program, but it's usually backed with physical gold, and again, that takes out a lot of the physical stock from circulation.
Maybe just a quick add-on on India. The fourth largest jeweler in India actually bought Valcambi, which is to be number 2 refiner in Switzerland worldwide, and as basically all the output out of this refiner is now disappearing into India. Yeah. So you start actually seeing that the gold flow is not really going anymore through the LME and the COMEX, it's going through the refiner, and it disappears into storage or jewelry making, or wealth preservation through jewelry, or whatever you want to name it. So that basically leaves the futures market actually a bit dry on physical supply.
Right. You mentioned earlier about sort of facilitating the exchange of physical. Any new sort of technological developments to help that space? I mean, I believe that up in China now you can, you know, buy on your WeChat platform, your WePlay platform, you can sort of buy little portions of a gold bar and things like that. Any comments on that, and whether that's going to, you know, unlock gold ownership for the masses, so to speak?
I think if you Google today, gold-backed ICOs, you know, you probably get like probably 24 of them. I think the idea of a gold digital currency is not new. It's been tried before in the past, but I think what is interesting today is that the technological side has advanced a lot, and you know, you have blockchain and things like that. But at the end of the day, I think people who want to buy these fractionalized units of gold will ask, you know, do I actually own the gold, and where is it stored, right? And I think that is an important part to answer, you know, to be able to bridge the gap between, you know, the technology side and actually who actually owns the physical storage. So on that note, we've seen quite a number of approaches from different ICOs, and funnily, they all tend to be based in Russia. You know, we are very cautious about you know, this sort of approaches. But then again, I think we recognize that there is a need from these ICOs that they need to have some sort of backing in terms of gold. And we have on our digital side, have actually been able to fractionalize gold that's stored with us, mainly because we started off, you know, with the physical infrastructure, dealing with storage. And I think that's going to probably be a big area for us moving forward. Yeah.
And of course, one of the big issues with sort of so-called paper gold is that people are not sure where their gold is, or whether they are the sole owners of that bar of gold. whereas with a blockchain-based system, the promise is that, you know, you'll know exactly which portion of the gold is yours. It'll be completely transparent, traceable, trackable, all that sort of thing. But still, you know, obviously a lot of caution in that space at the moment as it develops.
Absolutely, I think the ICOs and tokens have taken off, like like your usual startup company with a very broad idea of what's doable out there, and it hasn't really translated down to where the gold is stored and who owns it. And that's not an issue that we've had, because for everything that we store in the vault is actually allocated. You could actually tell exactly where your piece of gold is. If Tom owns a gold and he's visited a vault, we are not having those sort of problems. So I think it's a matter of bridging the gap between the storage and the administration side with what is out there today in terms of technology.
Absolutely. Let's move on to talk about equities, gold mining equities, and how they've performed. First of all, mining companies managing their costs, doing quite well in terms of getting the costs down and keeping those under control. Jorgo, what's your thoughts on how mining companies are performing?
Let's quickly look first. I think people are in the financial industry looking at tail risk management when they allocate money. And to allocate money as a tail risk management, as part of your portfolio management, you will look at two things. Either zero correlated risk with anything. You might want to buy physical gold because it's probably the cheapest insurance. Or you start looking at mines who are able to be an option on that trade. Unfortunately, the market today is still very, very disappointed about this bear market, which we've been in now for about 7 years. So the allocation of money is actually still bipolar. And bipolar means you're sitting with the best management, the best ore bodies, the highest margins, and the highest return on capital, which is able to provide repayment to the shareholder. And if you actually look at that segment of companies, they've been performing fantastically this last 12 months. And I think this trend will continue until gold starts breaking out of the trading range it's been sitting. The other strategy people actually have been able to do, because gold is being considered a high volatility investment, not from a gold point of view, which has been flat, but from a mining point of view. And if you look at the volatility, you get probably annualized volatility of somewhere between 20 to 25% still, compared to basically volatility writing on your normal exchange. I think a Nestle pays you probably about 5.5%. So how you're protecting your investment with a 5% yield, you basically can't really do that. But if you're able to write volatility on some of the key best names on a 25% annualized premium, you're clipping every month 2% premium. That's a huge amount, basically, of protectionism you have. So I think that's the different ways you can skin it. If you look from a cost point of view in the mining industry, I think the low of cost has been in, because all the ingredient costs of mining is going up. And that means you're going to start looking as an investor even more at companies which have high margins, which are able to support it better. That means you need higher grades, you need a better, a simpler ore body, you need a better infrastructure, you need scaling. And that means actually on an 80 to 20% rule you have in almost every investment, there are probably less than 20% of the companies which will cut it, even just if you look at the top 200 companies in the world. So that doesn't leave you actually with a lot of investments to choose from.
What are the main things driving the costs up at the moment?
I mean, if you're a really low-grade producer, it will be energy. And if you look at the energy costs, it's going through the roof. Your oil price has almost doubled. The second one is basically material. And you look at steel prices and all that stuff, it's gone basically through the roof. And the third thing, I think, is if you look at emerging markets, we already have rampant wage inflation. And this wage inflation is actually even coming through in countries like the United States. If you look at the wage growth chart in the United States, it's been growing for about 2 years. And it's well above the official inflation numbers. So your three key ingredients on cost in mining are all going up.
But are gold miners in a better position than others? Because Obviously, gold is not a bulk mining operation. It's, you know, it can be fairly targeted. You don't need the huge trucks and labour. Well, not as big as you would for a sort of iron ore mine or a coal mine or something.
If you're a 1 gram ore body, you are actually a bulk operation, right? So the question then is, you know, what type of mining you're looking at, where you have higher grades, where you can optimize your cost. But as I said, that's probably the minority of the companies which are around. And I think that's where our work goes in trying to figure out where these investments are, where the opportunities are, and where we can unlock the value to add the outperformance over time.
Thomas?
Yeah, I agree with everything Jörg said. We probably have seen the low in the cost structure. Companies, the industry in general has restructured massively after the cost spiked at the top of the last cycle. At the same time, it's interesting that a lot of companies on the TSX in Canada, there's still 3,000 listed companies, and you would have expected that a lot of them have disappeared in the bear market, but they're still around. Some of them are zombie companies, but as an investor, you have to go back to good old-fashioned due diligence and picking stocks, because at the end of the day, in the next bull market, the tide will lift all boats. But initially, you see high-quality companies performing very well, even though generally the junior mining market is going so flat and is not really going anywhere. But on an individual company basis, you can see very dramatic moves on good news. And one effect of the relatively strong dollar right now is that the emerging markets currencies are coming under a lot of pressure again. Gold is at an almost all-time high in Brazilian real. Argentinian peso is collapsing. So it makes a huge difference if you're an investor, whether you buy a gold mine in Argentina, where you benefit from the currency effect, or let's say if you buy an airline in Argentina, you have a problem right now.
So where's the best place to buy a mine, to invest in a mine? Which countries are, you know, best on costs and best on currency?
I think at the end of the day, it comes back to grade. Grade is still king. Grade solves every problem. Like Jörg said, if you have a 1 gram per ton ore body, it's going to be difficult in most jurisdictions and in most currencies. If you have a high-grade mine, you get away with almost everything. And if you have a high-grade mine in an emerging market, like in Brazil, it's fantastic right now.
Fantastic. Jörg, do you have any thoughts on where's the best, which countries are sort of better at the moment?
Look, I think with the world in turmoil, risk management in countries becomes much, much harder. In an environment where we have a strong dollar, you have actually margin call on almost all the other currencies, which means risks are going up in almost all the other currencies than the dollar. So I'm not really that specific too much about country. I mean, there's some areas where we probably stay away because we think that the pressure which are coming through the financial system are creating social structures which are forcing government to increase taxes and revenues. But what we are looking at actually is ore bodies, quality of management which is able to unlock value for shareholders. And if you actually look around, there are probably at least a dozen companies around the world which have ROEs, ROIs, ROCs with no debt of well over 20%. So in the highest case, it goes up to 50. So basically, you get the repayment of your capital in an incredible fast time with actually very little risk. So you get paid whilst you wait for the gold price to go up. And I think that's probably not a bad strategy until you really believe that the gold market is flying. I think what you mentioned, that the emerging market currencies, gold price are already an all-time high. Yes, they've broken up on the upside. They are running already. The only man standing right now where the gold hasn't broken to the upside is actually the US dollar, and it's probably the last man going.
And you mentioned, you know, obviously everyone says they want a good management team, but what do you look for in that team? What's the magic formula?
I think being on-site and managing the enterprise, including having some commitment to the investment. I think what we're seeing so many companies which have incredible high G&A cost, have bonus packages, getting free shares, but haven't really bought a single share of themselves. So if you actually look at the leading gold miners, all of them, management or families, are controlling stakeholders or have huge amount of exposure in a company. So they have something to lose. So to me, I think having all these blocks aligned is pretty much key. If you can't have that, then I don't know where you're going to get the win-win.
Do we have any questions from the audience? A question in the middle here. If we could get a mic.
On the Singapore Exchange, there are 3 small gold mining companies. Traditionally, I know gold mining companies are like in Africa or in Australia. On the Singapore Exchange, there are 3 very small gold mining companies. But from what I read about them, yields seem to be quite high. It's like 6 or 7 grams per ton of ore. And they seem to have a different kind of business model in the sense that they totally subcontract the mining to a China company, and they also export the gold as gold concentrate, thus saving a lot of costs. What do you think of this kind of companies that seem to be from areas other than Africa and Australia? Thank you.
I think most of them are either mining in Malaysia or in Indonesia, if I'm right.
Yes.
They are small scale,
Yes.
so scalability is an issue. It reminds me of high grading, so the question becomes sustainability, life of mine. And, we can always outsource a lot of things. I think for smaller mines, outsourcing makes a lot of sense because the capital investment costs are in general too high. But what comes on the back of that is that you're losing margin because nobody takes that stuff off you without making money themselves. So it's, there might be different courses for different people. What we are looking for when we're looking at mines is actually growth and is able to have a mine which becomes a meaningful mine in the environment of investors. So it attracts bigger pots of money. And I think that's where most of these mines, which you're probably referring, might fail on scalability and growth of becoming a meaningful mine in the universe. I think if you look back probably 50 years ago, you produced 25,000 ounces of gold a year. People said, wow, that's a respectable mine. And today, 25,000 ounces of gold, nobody looks at it anymore. So how are you going to get your uplift on prices and valuation over NPV? I think that's probably the biggest question. Does it become a dividend yield and payout structure? I mean, look, I'm not telling you not to invest, but I think I'm telling you what the global community is looking for when they invest money.
Yes, thank you.
Any further questions? Question here from Edward.
Hi, Edward Gustley from Pineda Capital. This, I guess, is directed to Thomas. Can you give us an update on the market for streaming? Is there demand in the region? Is it soft? Where is it coming from? And are the margins still and returns still relatively good for streaming? Thank you.
Maybe just for those who don't know what streaming is, we're not talking about Netflix or anything like this. We're talking about streaming commodities. So we invest in a gold mine and get paid back in gold. It's basically a prepayment of gold to be produced in the future. It's a model that was invented in Canada about 15 years ago. And there's 4 big streaming companies like Franco-Nevada, Silver Wheaton, and as an investment, they've done fantastically well, and they're very popular among investors because they don't take the mining risk, the operational risk. So streaming is becoming increasingly popular, and because of those factors, people want to invest in mining, but they don't want to take the operational risk. So you invest in a streaming company. Unfortunately, someone at the end of the day still needs to operate a mine for the streaming company to have any revenue. So the market is still very competitive, and it's getting increasingly competitive because there are only 4 big streaming companies chasing the same projects, and we're talking about hundreds of millions of dollar investments in CapEx. Those streaming projects are getting increasingly expensive, so the streamers make only 5% IRRs. So the reason why the streaming companies are so highly valued in the stock market is not because their projects have initially a huge IRR, but the streaming company gets basically a free upside on any exploration success, any life of mine extension, and this is where the upside is coming from. So yeah, the streaming market is extremely competitive. The junior segment of the streaming market, where we play and finance junior companies in the streaming segment, it's still very selective, and there's a few more companies trying to get into the sector, but it is also high risk, and you need to have firepower, because we've seen it in our companies. Every single project gets delayed and needs more money. So if you have a small streaming company and you think, I have a limited amount of money, I'll do a stream on a junior, it's going to blow up. So you need firepower and additional money if and when necessary. And yeah, you need to be prepared to manage the project actively. And the returns accordingly are still very interesting. There will be a point in the market when the equity prices go up again, where companies will be able to finance themselves with equity. But currently, and for the next foreseeable future, I think streaming will still be very attractive also for juniors.
Franco-Nevada, I think, had 16 billion market cap or something. I think they have about 35 employees or something like that. So they're doing, it's quite a nice little sort of thing. Anyway, don't quote me on those figures, but there we go. Unfortunately, we've run out of time. Again, that 40 minutes just flew by. We've covered a lot of ground there, but quite a positive outlook, I think, there. You know, sort of gold has sort of slightly underperformed on the equity side, but, you know, there's plenty of gas in the tank, so to speak. So thank you very much to our panelists. If you want to have any more questions for them, please get them afterwards. But,